IRMAA stands for Income Related Monthly Adjustment Amount. But all you really need to know is this: it's a stealth tax. It hits your Medicare premiums, shrinks your Social Security check, and compounds over time. And the only way to avoid it is to understand it. So in this lesson, you'll learn what triggers IRMAA and how it's calculated, why the triple compounding effect can quietly drain your retirement income, and how smart planning, like using Roth conversions and whole life insurance, can help you avoid unnecessary surcharges. If it's your first time here, I'm Dr. Amanda. Welcome to the Retirement Income School. This is your place for financial education on how to protect your wealth and create guaranteed lifetime income so you can retire financially relaxed. In my last few lessons from the Retirement Income School, I've received several questions during consults about IRMAA. So I wanted to do a quick explanation for you in this lesson. Let's start with the most basic. What is IRMAA? IRMAA stands for Income Related Monthly Adjustment Amount. And it's an extra charge that's added to your Medicare Part B and Part D premiums when your income crosses certain thresholds. And the higher your income, the higher your Medicare premiums. And these premiums are paid out of your Social Security benefits. So you don't pay these out of pocket per se, but they reduce your Social Security benefit and take the IRMAA surcharge out of your Social Security benefit. Sometimes this makes you not even know that it's happening. And so let's pay attention to what these charges are so you understand your IRMAA surcharges. IRMAA is based on your modified adjusted gross income from 2 years ago. And the income sources that count are IRA withdrawals and RMDs, Roth conversions, capital gains and dividends, taxable Social Security, tax-free municipal bond interest, and rental income. So those are all of the sources of income that are going to be included to calculate your IRMAA surcharge. And like I said, your IRMAA surcharges are based on your income from 2 years ago. So here's an outline of the 2025 IRMAA brackets, and these are for married filing jointly. And again, these are going to be based on your 2023 income. So here are the income ranges. If you're making up to $206,000 married filing jointly, then your Part B premium would be $174.70. That's the base premium. If you have income from $206,000 to $258,000, then it goes up to $244.60, and these are per person. Then if you've got income between $258,000 to $322,000, then it's $349.40, and it goes on all the way up. If you're making over $750,000 per year, then your monthly IRMAA surcharge on Part B would be $594 per person. And then for Part D, there is an additional $12 to $81 per month per person. So if you're in that top bracket, it's going to be $81 extra per month. Let's look at the impact on a married couple in the top tier who could face $16,000 plus per year in IRMAA charges. Because if you add up $594 per person on the monthly Part B, that's $594 per month. That's for each person for Part B. Then you add $81 per month for Part D, and then you multiply that by 12 to get to your total number of more than $16,000 for your annual IRMAA surcharges. And this is before copays and healthcare costs. So this can be a significant impact on your annual healthcare expenses. And most people never see these escalating costs coming. And so it's really important to plan for this. And you might have heard this before. IRMAA is really known as a stealth tax, and there's a triple compounding effect of IRMAA. So it isn't a one-time fee, and it snowballs over time in 3 key ways. First, there are annual increases. So IRMAA is recalculated every year, and if your income keeps rising, your surcharges do too. And then the second is that there's tax plus an IRMAA feedback loop. And what that means is that you take withdrawals from Roth conversions. This increases both your taxes and your IRMAA charges, and you can't deduct those extra premiums. And then the third compounding effect is that it reduces Social Security income. So IRMAA is withheld from your Social Security check. Now you have less cash flow, and this means that you need to withdraw more. And this just creates a really vicious cycle. The term stealth tax is really interesting. It means a stealth tax, like IRMAA, quietly erodes your retirement income by compounding in three ways. It raises your Medicare premiums as your income increases, shrinks your Social Security checks, and forces higher future withdrawals, all without ever being called a tax. So that's why people call it a stealth tax. It's this hidden tax that's eroding your income, and a lot of people don't know very much about it. I've been really intrigued by how many people I talked to who didn't even really know that IRMAA surcharges are coming out of their Social Security check. So this is something that's going to have a larger compounding effect for larger IRAs and 401ks. You've heard me talk in previous lessons about doing Roth conversions to strategically plan for these increasing IRMAA surcharges. And so let's dive into that a little bit, how to reduce or avoid IRMAA. You don't have to be stuck in the IRMAA spiral, but you've really got to plan early. And one of the strategies that you can use is a Roth conversion. This needs to be done strategically during lower income years to manage future taxable income. You can also use whole life insurance. So you can create tax-free income that doesn't count toward your modified adjusted gross income by pulling out loans from your whole life policy that you've built up this banking system for yourself where you have tax-free income during your retirement years. Now, obviously, this is going to take planning, and you want to be planning this ahead of time. So whole life insurance can be a great strategy when you start earlier in your 40s and 50s, even 60s, and you start thinking, okay, how am I going to start putting income away into a tax-advantaged plan so that I don't have these IRMAA surcharges later? You can also start putting additional income into Roth IRAs instead of traditional IRAs so that you have less taxable income when you're moving into those retirement years, especially when you're planning for RMDs. And you can also use fixed index annuities, so structure income that can be managed around thresholds. So Roth conversions, whole life insurance, fixed index annuities, these all take some planning so that you control your income. That way you control your IRMAA premiums. Now keep in mind that IRMAA is just one piece of the retirement income puzzle. In order for you to really know what strategy is going to work the best for you, we need to think about your age, your retirement goals, your income level, your tax bracket. So everybody's situation is going to be unique. If you want to have a chat and see what would be the best fit for you, go to retirementincome.school. At the top of the page, you'll see a button that says book a Q&A call. We'll have a chat and we'll look at specific solutions that are unique to you, and we'll go from there. Again, that's retirementincome.school. Book a Q&A call. I can't wait to talk to you about your retirement income. And as always, thanks for being here for another lesson. If you have not yet subscribed to the YouTube channel or podcast, do that now. Click on the notification bell so you never miss out, and continue to stick with me here at the Retirement Income School, where I'll keep bringing you lessons that will help you keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.